Let's say you've got a little extra cash at the end of the month. Should you use it to pay off your debt, or should you invest it and grow your money? This is one of the biggest questions people face when they get serious about their finances, and it's not always black and white. In this video, I'm going to break it down step by step. No jargon, just real talk. We'll look at how debt works, how investing works, and how to make the smartest move for your situation in 2025 and beyond. Understand good debt versus bad debt. Alright, let's clear something up right away. Not all debt is created equal. Some debt can actually work for you, while other debt works against you, big time. This brings us to the two big categories, good debt and bad debt. Let's break it down. What is good debt? Good debt is the kind that helps you build wealth or increase your income over time. It usually comes with low interest rates and a clear return on investment. A student loan that helps you get a degree and land a higher paying job. A mortgage that lets you buy a home, which could grow in value over time. A business loan used to start or grow a company that brings in more income. If your loan is helping you make more money in the future or giving you access to valuable assets, that's generally good debt. What is bad debt? Now, on the other hand, bad debt is the type that drains your money without building anything valuable in return. It usually has high interest rates and often funds stuff that loses value quickly. Credit card debt from shopping or dining out. Payday loans with outrageous fees. Buy now, pay later. For things you didn't really need in the first place. Bad debt is like a leaky bucket. You're pouring money in, but it's slipping right out of the bottom in the form of interest charges. If you've got credit card debt charging you 18%, 22%, even 29%, that's a red flag. You could be investing and making 8%, but you're losing way more just by carrying that debt. So here's the rule of thumb. If the debt is helping you grow financially, and it's low interest, it may be okay to keep while you invest. But if the debt is high interest and isn't adding value to your life, it's gotta go. Period. Now that we've got that foundation down, let's talk about how to compare the numbers and figure out where your money should really go next. Compare interest rates versus investment returns. Alright, let's get into the real numbers. Don't worry, I'm keeping this super simple. Here's the big question. Is your debt growing faster than your investments would? Because if it is, you're actually losing money. Let's break that down with an example. Example 1. High interest debt. Say you've got $5,000 in credit card debt with a 20% interest rate. That means if you don't pay it off, you'll owe about $1,000 in interest after 1 year. Now, let's say instead of paying that off, you invest that same $5,000 into the stock market, maybe in a solid index fund that averages around 8% a year. That would grow by about $400 in a year. So let's compare. You're paying $1,000 in interest, while earning only $400 from investing. That's a net loss of $600. Ouch. In that case, investing might feel productive, but it's actually setting you back. You'd be better off using that money to wipe out the debt first. Example 2. Low interest debt. Now, let's flip it. Say you've got a student loan at 3% interest. That same $5,000 debt will only cost you about $150 a year in interest. But if you invest $5,000 and earn that same 8% return, you're making about $400. Now that's a win. You're coming out ahead by $250 just by investing instead of rushing to pay off that low interest loan. So in this case, investing might be the smarter long-term play. So the simple rule here is, if your debt interest rate is higher than your investment return, pay it off. If it's lower, investing can work in your favor. It's like comparing leaks and buckets. If your debt is leaking faster than your investments can fill up the bucket, plug the leak first. The key takeaway? Crush high interest debt first. It's like a financial fire. But low interest debt? That gives you more flexibility to build wealth through investing. Why you might want to do both. Alright, this is where it gets exciting. Because here's the truth. You don't have to pick one. You can actually do both. Yup, you can pay off debt and invest at the same time. Enter the 50-50 rule. There's a smart strategy called the 50-50 rule. It's exactly what it sounds like. You take any extra money you have, after covering your essentials, and split it evenly. 50% goes toward paying down your debt. 50% goes toward investing for your future. This way, you're not just fixing your past financial mistakes, You're building your future at the same time. Why this works? Let's say you've got a credit card balance, but the interest rate isn't super high, maybe 10% or less. And you also want to start investing because time in the market is how your money grows. The 50-50 rule keeps you from feeling stuck or overwhelmed. You don't have to wait until you're debt-free to invest. And you don't have to ignore your debt and hope it goes away. Because, spoiler alert, it won't. It's a mindset shift. Instead of choosing between freedom from debt or freedom to build wealth, why not have both? Other split options. Now, if 50-50 doesn't feel right for your situation, you can totally tweak it. Some people do 70-30 or even 80-20, depending on how urgent their debt is. If your debt is higher interest, lean more toward paying it off. If your debt is low interest and you're young, lean more into investing. The key is making progress in both areas. You want to look back a year from now and say, hey, I owe less and I've got money growing in investments. That's a powerful combo. Now that you know you can do both, let's talk about where to start if you're just getting into this money game. What if you're just starting out and feeling overwhelmed? Totally normal. Maybe you're thinking, I've got student loans, I'm barely saving, and investing sounds confusing. Hey, we've all been there. But here's the good news. You don't need to be rich to start making smart money moves. Let me give you a super simple roadmap to get things rolling, even if you're starting from scratch. Quick 3-step starter plan. 1. Build a starter emergency fund, $500 to $1,000. Before you throw money at debt or stocks, get yourself a small safety net. It doesn't need to be 6 months of expenses right away, just enough to cover a car repair, a medical bill, or a surprise bill without panicking. 2. Attack high-interest debt. Next, focus on the toxic stuff: credit cards, payday loans, anything with sky-high interest. Every dollar you throw at that now is saving you from losing way more later. 3. Start investing. Even if it's just $50 a month. Once you've got that little cushion and you're tackling bad debt, it's time to invest. Even if it's just $50 a month into an index fund or a Roth IRA, do it. Because when you start early, time becomes your biggest asset. Compound interest is your secret weapon. Let me break it down. If you invest $50 a month starting at age 25 and your investments grow at 8% a year, you'll have over $150,000 by the time you're 60. But if you wait until you're 35 to start, you'll only have about $66,000. Same monthly investment, just less time. That's the power of compound interest. It's like planting a tree. The earlier you plant it, the bigger it grows. Final words for beginners. So if you're just starting out, don't worry about being perfect. Just get moving. It's not about how much you have right now, it's about building the habits that will pay you for life. You don't need a 6-figure salary to build wealth. You just need a plan. Okay, real talk. Money isn't just about math. There's also an emotional side to this. For some people, just knowing they're in debt causes stress, anxiety, and sleepless nights. And in that case, paying off debt fast, even if it's not the highest interest, might bring peace of mind. And peace is priceless. Others get really excited about investing. They love seeing their net worth grow and their money work for them. So ask yourself, what motivates you more? The freedom of being debt-free or the thrill of growing your investments? Here's the bottom line. Whether you pay off debt, invest, or do both, the most important thing is that you're doing something. You're taking control. And every step forward gets you closer to financial freedom. Comment below. What's your plan? Are you focused on debt, investing, or both? And if this video helped, make sure to hit that like button, subscribe, and share it with a friend who needs this info. Thanks for watching, and remember, money isn't just about spending, it's about choosing freedom. One smart move at a time.